Exchange-traded products, or ETPs, are investment products that are traded on stock exchanges, much like individual stocks. They offer investors a way to gain exposure to a basket of assets, such as stocks, bonds, or commodities, through a single investment. This makes them an attractive option for investors looking to diversify their portfolios and gain access to specific market segments. ETPs have become increasingly popular in recent years, offering flexibility and cost-effectiveness for both novice and seasoned investors alike. ETPs provide a convenient way to invest in a variety of assets without having to purchase each one individually. This can be especially beneficial for investors who are just starting out, as it allows them to easily build a diversified portfolio. Imagine trying to buy every stock in the S&P 500 index individually. It would be a logistical nightmare. With an ETP, you can achieve the same exposure in one simple transaction. There are several different types of ETPs, each with its own unique characteristics and investment objectives. The most well-known type is the Exchange-Traded Fund, or ETF. ETFs typically track an underlying index, such as the S&P 500 or the Dow Jones Industrial Average, and hold a basket of assets that mirror the composition of that index. Another type of ETP is the Exchange-Traded Note, or ETN. ETNs are debt securities issued by a financial institution that track an underlying index or benchmark. Unlike ETFs, ETNs do not actually hold the underlying assets. Instead, they promise to pay investors a return linked to the performance of the index, minus any fees. Finally, we have exchange-traded commodities, or ETCs. As the name suggests, ETCs track the price of a specific commodity or basket of commodities, such as gold, oil, or agricultural products. They offer investors a way to gain exposure to the commodities market without having to physically hold the underlying assets. ETPs offer several advantages over traditional investment vehicles such as mutual funds. One of the main advantages is their low cost. ETPs typically have lower expense ratios than mutual funds, which means investors get to keep more of their returns. This is because ETPs are passively managed, meaning they track an index rather than trying to beat the market. Another advantage is their flexibility. ETPs trade on stock exchanges just like individual stocks, which means they can be bought and sold throughout the trading day. This is in contrast to mutual funds, which can only be bought or sold at the end of the trading day at a price determined by their net asset value, or NAV. ETPs also offer greater transparency than mutual funds. The holdings of an ETP are disclosed daily, so investors always know what they are invested in. This is not the case with mutual funds, which only disclose their holdings quarterly. ETPs are created and managed by financial institutions known as sponsors. The sponsor selects the underlying assets that the ETP will track and creates a portfolio that mirrors the composition of the index or benchmark. The sponsor then issues shares of the ETP, which are listed and traded on stock exchanges. When an investor buys shares of an ETP, they are essentially buying a fractional ownership in the underlying portfolio of assets. The price of the ETP will fluctuate throughout the trading day based on supply and demand, just like any other publicly traded security. When an investor sells their shares, they will receive the current market price.